I think I will give you straight away the floor so that we can start, and we still have, I think, a good 1 hour ahead of us.
Okay, thank you, Panos. I'll go even faster through the introduction I was planning. I started off saying that the secret of economics journalists is that we don't like tax, but actually I've discovered, looking at this OECD deal, that it is one of the most fascinating, important topics today, because it touches on big issues of sovereignty of nations, models of economic development, climate, the future of globalization, technology, how do we deal with global tech firms, and crucially for this conference, it's also central to questions of inequality between firms, people, within countries and across borders. So we've got this OECD deal, which our political leaders are describing as a revolution. And so I was just going to briefly say what that deal is, and I'm very happy to be corrected by our much more competent panelists. So there's 2 pillars to this deal. The first pillar is about a fairer distribution of the right to tax the largest multinationals, often and controversially called a digital tax. Pillar 2 is the topic today, is a global minimum tax for corporations to stop a race to the bottom. And I think we're going to divide this into 3 sections. So firstly, I guess we'll be looking at whether this is a revolution or an evolution. And then we'll be examining the issue of the race to the bottom and whether we've put an end to that or not. And then the questions of implementation and what comes next. So very briefly, we've got a great panel to discuss this today. Lucas Chancel, co-director of the World Inequality Lab, an expert on income, wealth and carbon inequality. So hopefully he will be able to speak to whether the tax revolution is an inequality revolution. Theresa Neef, a researcher of the EU Tax Observatory and the World Inequality Lab, where she plays a leading role in research regarding inequality and tax avoidance. I think she'll be able to tell us about how much is at stake in this revolution. David Bradbury from the OECD, head of tax policy, and he has a unique view from inside of the room of these negotiations to what degree, what a revolution looks like from the inside. Sven Giegold, MEP, who has called the minimum tax, I believe, an important step forward that nonetheless fails us to bring us over the finish line. So I'm hoping to hear from him what more is needed for a revolution. And then Guntram Wolff, director of the Bruegel think tank, who will be able to speak to what this means for Europe and hopefully some of the economy questions. So with no further ado, we'll get to our first chunk, which is whether this is a revolution or not. And perhaps we start with David Bradbury to give us a brief overview of how this 137 countries came together to decide on a global minimum tax. And it's gained a lot of momentum in the last year. And so what were the driving forces and the main changes that enabled this deal?
Thanks very much, William, and great to be able to join you, albeit remotely. Yes, in terms of whether it's a revolution or not, frankly, I'm happy to leave that to others to make the judgment. For us at the OECD, we've been working very closely with the member jurisdictions of the inclusive framework, and I think it's important to highlight the fact that these discussions, yes, the OECD has been hosting them, but it really it's been about discussions amongst more than 140 jurisdictions across the globe coming together on an equal footing. Now, of course, in pandemic times, those discussions largely have been carried out by Zoom, which has added a new and different dimension to the dynamics behind the discussions. But I think that what we can say about the agreement that was reached on the 8th of October is that it is one of the most significant changes or agreements to change the international tax landscape in the last 100 years. Now, whether that's a revolution or not, I leave to others to make their judgment. But why is it so significant? Well, I think it's significant for a few reasons. And William, I'm really pleased that you mentioned Pillar 1 as well. I know the focus of the session is Pillar 2, but it's really I think you're not able to talk about the dynamics of the negotiations or the agreement without recognising that there were two components to this, Pillar 1 and Pillar 2, and they were a combined deal. So there were elements that people may have liked on one pillar and may have not liked on another pillar, but in order to reach a consensus across the what we ended up with, more than 155, we ended up with 137 jurisdictions signing up to the agreement. There was compromise across the two pillars. Now, I think that there'll be a lot more discussion in the next round over the objectives of the reform itself. But just to reflect quickly on what I think have been the drivers that have led to the agreement in more recent times. Let's just step back for a minute. I've been working at the OECD for 7.5 years, and I joined the organisation when the BEPS project was underway. And there were great ambitions as part of the BEPS project, and many of them were realised in terms of the anti-avoidance measures that were agreed at that time. But a couple of significant things have happened since that have allowed some more fundamental questions to be addressed. And when I say more fundamental, I'm talking about the nexus and profit allocation questions that were tied up in Pillar 1, but I'm also talking about the idea of a global effective minimum tax, which even back in those days of the BEPS project would have been seen as something that would have been beyond the reach of international agreement. Yet here we are today in a context where there has been agreement at that high level. So what has happened since? I think, firstly, we have seen the economy continue to digitalise rapidly, and it has become increasingly clear to all countries that the implications of that digitalisation and globalisation have made the existing international tax rules out of step with the modern economy. So that's the first thing. The second thing is that we had a renewed effort to try and reach consensus on how to respond to these challenges in the 2018 interim report. Now, at that time, what was also clear was that we were still some way away from reaching a consensus on how to reform the system. And in the absence of that agreement, we saw a number of nations begin to take unilateral measures. And to some extent, the unilateral measures really ramped up the temperature in this debate. We saw some digital services taxes being introduced, and not just digital services taxes, other unilateral measures, but then we saw retaliatory responses in the form of trade retaliation from the United States and the threat of counter-retaliation. Now, this really meant that what was essentially a niche tax issue for some people became all of a sudden an issue that posed greater threats to the global economy in terms of the trade spillovers that might occur. And it was the Trump administration, in fact, that came to the table willing to engage in a new round of discussions, but then also in the course of that administration, a number of stumbling blocks emerged, in particular in relation to Pillar 1. And then it was with the change of administration in the US and what I think was quite a new outlook that really resuscitated those talks and breathed new life into them. And at that point, I think that really said to the world that the United States was ready to try and remake the international tax rules and to reach agreement to do that. And for all those that had been calling for this for some time, there was a recognition that now was an opportunity to seize. And for those that had resisted that change, I think they also saw the writing on the wall that there was a critical mass of support for reform of the international tax rules. So I think all of those dynamics have really been driving what's been going on. And the final point I'd make is the pandemic and the impact and the pressure that it has been placing on public finances. And clearly that has made some of these questions even more pressing for governments to tackle.
Okay, thank you. Perhaps turn to Sven. So I suspect you may be not quite so sure of the revolutionary aspect of this minimum tax. Am I right in suspecting that, or are you converted?
Well, all these questions are great, but of course, first today we are electing a new chancellor, And he has, Scholz, who was so far the German finance minister, and he has called this revolutionary. And as a Green, I have to say, I'm always a bit skeptical if social democrats talk about revolution. That is not their main special focus, Guntram. You may agree. So I would rather call this a significant revolutionary pocket. So what I mean with this is, so everybody who knows a bit leftist terminology knows a revolutionary pocket is not yet a revolution. So because we are in Paris, it means you haven't taken over the Bastille yet. It's only one revolutionary quarter in Paris preparing for taking over the Bastille. That's where we are. Why? Because what is really new, and why I would say it's a revolutionary pocket, is that there is, at least for some companies, a minimum tax rate. This is really new, and it's totally different from what we had before. And second, as David was pointing out, there's also a quantitative rule how to distribute profits across states. Yeah. However, the method, so the base is very limited because it's only the profit of transnational corporations and above the 750 million turnover threshold. And it is also only a tax rate of 15% effective, which is, of course, a lot in comparison to a growing number of tax jurisdictions with zero tax rates, but it is far too little to defend the progressive income tax regimes, which we are so proud of, for instance, in Europe, but also many other countries globally. And third, the base for the redistribution of profits is also limited because many companies, they expand rapidly, but they don't book high profits. So if you take, for instance, the giant Amazon, outside of their cloud service operations, so with the bulk, which is causing a lot of their business model, they are not covered by the deal. So you can build ever more this, online shopping world, while you do not book profits above 10%, you will simply not be covered of any redistribution. So what I want to say is the myriad of smaller companies are excluded, although we all know for tax avoidance, tax evasion, money laundering, we are mainly speaking about small companies. Obviously, for this, we have automatic information exchange, at least when they only have a limited number of beneficial owners. However, everything in between is not covered by anything, and the automatic information exchange is not effectively working because we know that a lot of the most criminal users of the letterbox imperium globally are never caught by their home tax authorities. So we still have a lot of work for the OECD, for the global tax community. So I would recommend concentrating in parallel on effective information exchange, covering more types of assets, such as real estate, such as opening of companies, buying shares in companies, covering effectively more complex structures which are so far not effectively covered, sanctions for financial institutions and other obliged entities which are not implementing effectively. And at the same time, it is important that we do not say we are ending up in a world where we have, in the end, 15% corporation tax and everybody harmonizing towards these 15%, which would mean that for instance, wealthy families could simply use a corporate shell in order to prolong the payments of income tax for a very long time. This is already done today. So everybody who doesn't want to spend money simply allocates it in a corporate using the privileges of tax, which are meant to be for corporations creating jobs, but at the same time allowing individuals to avoid paying on their allocation of income a progressive income tax rate. And this needs to be thought together so that we are not only talking about a very limited base for a minimum tax rate, but we are talking about the defense of progressive income taxation in order to reconcile open markets with limited inequality. And this is what we should really strive for. And for this, the reform is a helpful revolutionary pocket. But whether the forces of tax competition will win over the revolutionaries, or whether the revolutionary pocket will finally take over the Bastille of inequality and tax competition, this is the open question of the years to come.
Okay, thank you, Sven. Perhaps we'll come back to the future challenges later in the panel, and maybe David can respond to some of them. I'd like to go to Guntram now. It's pretty rare for Europe to agree on tax. So is this a tax revolution in a European sense?
Well, thanks a lot, William, and thank you for bringing us together to discuss this issue. I mean, I think the first point I really wanted to make is sort of stepping back and looking at the long-term picture. And the long-term picture globally is one where the share of income that is generated in our economies that goes to labor income is falling and has been falling for decades in many of the big jurisdictions. Now, not everywhere, and there have been some reversals in trends in the last 10 years. But still, if you look at the last 30, 40 years, that's the picture. Which means, as a consequence, that the share of income going to capital has been on the rise. And if you look at the distribution, on the other hand, of tax revenues, you will see that the central pillars of tax revenues remain labor income taxation and VAT. So there is an imbalance here that in our economies, more and more of the value that is getting created is created as capital income, but the tax burden, in a sense, is increasing on the factor that receives less income. So I think that's the broad picture, and I think that picture means, yes, we needed a deal. The world needed a deal on corporate taxation to make sure that this imbalance gets addressed. Now, I'm happy to see that the agreement, according to the various estimates that are out there, and I think Theresa will talk about some of those estimates, show that the deal will actually generate additional tax revenues, and I think that's a good news, right? Now, at what stage, at what kind of additional tax revenue you call something a revolution or the taking of the Bastille? I mean, that is, I think, I guess, in the eyes of the interpretation, I think it's definitely a positive step forward. But I also agree that, there are significant parts of the international tax system that, are still not optimal. And, I think Sven pointed us to a number of issues such as small companies that are hidden in some islands, and whether you have actual tax evasion or even tax fraud. I mean, these issues still remain unaddressed. But I think what this agreement does is it has a big focus on the big companies, and it is interesting and important that these big companies get into such an agreement. Why is that? Well, also because there is a tendency now that these big companies become so-called superstar firms. There's a whole literature on these superstar firms. Digitalization, innovation are increasingly concentrated in these kind of big firms. They are successful firms, and of course, the world needs to make sure that they actually do pay their fair share of taxes. So then coming to the European Union, which was your question, I mean, in a sense, it is testimony of the poor state of capacity in the European Union to act, that this only could be agreed on once the US was fully behind it, and there was a deal at the OECD level. I mean, many of the issues could have been addressed and should have been addressed some time ago already within the European Union. But as you know, the European Union on tax matters requires unanimity, and there have been a few member states within the European Union that essentially have blocked any progress. And now they could be brought on board, but only because there was so much more pressure from other jurisdictions, including the United States, that in the end sort of made it possible to get their consent. Now, not everything has yet been legislated, so there's still some road ahead, I would say. But my assessment would be that the central pillars that have been agreed will go through the legislative process. It will still be fights, but I think at the end of the day, the big ticket items will go through. So I guess I would conclude by saying, yes, it's not a revolution probably, but it's a really important step forward. And I think it's social democrats, as Sven said, might not be, and the future chancellor or the incoming German chancellor might not be revolutionaries, but they are here on the right side of the argument, and I think that's important. Thank you.
Thank you very much. And you introduced Theresa, and I think that she might be able to give us a better idea in euro terms or dollar terms. How much is at stake here, and how much Pillar 2, the minimum tax, can change revenues for governments?
Yes, exactly. Thank you, William. We have accompanied the negotiations of this year and the July and October agreement by providing revenue estimates of Pillar 2, so of the global minimum tax. But I have to stress that also the OECD did a very extensive impact assessment ex ante of the negotiations, which is great as well. But I think we had the advantage that we really could tailor our simulations to the agreements that came out in July and October, and we find that that Pillar 2 of the global minimum tax will produce substantial revenue. So we first simulated global minimum tax of 15% without carve-outs. I will come to the carve-outs in a minute. I'm a little surprised that they didn't come up yet. And for a global minimum tax of 15% without carve-outs, we find that the European Union EU27 could raise around 80 billion euros per year in extra revenue. That would be a quarter of current corporate income tax revenue. The US could raise over 50 billion euros per year as well. So from a perspective of Europe and the US, the global minimum tax can substantially raise revenue. However, it's the rate is one issue. So if you would go higher at a rate of 21%, those countries could actually double already their revenues. So as Sven already mentioned, this was actually a compromise of a quite low rate. But there's another issue. It's not only about the rate. There are also the so-called carve-outs. Those are provisions that give multinationals the opportunity to not change the rate, but to decrease the tax base to decrease their tax burden through decreasing that tax base. And this is possible if a company has substantial real economic activity in a country. So if it concentrates assets and employment in one country, then it can substantially decrease its tax burden, and with this, its tax base, and with this, its tax burden, even though the 15% minimum tax rate is set. And in the deal or in the agreement as it is laid out now, the carve-outs amount to 5% of assets, tangible assets, and payroll. And we find if this deal is, or the agreement is implemented as it is laid out, this deal would bring about 64 billion to 72 billion euros in extra revenue. This would be still quite a lot of revenue, but it would be a decrease of 15 to 23% in comparison to a minimum tax without carve-outs. So carve-outs can substantially decrease the revenue potential of the minimum tax. And not only this, they also inhibit that there will be a solid floor of 15% for multinationals to pay taxes. So I think those carve-outs are really crucial or critical for the revenue potential, but also to put a floor for a minimum tax. And there's another issue I would like to raise, where we have to see the agreement as it is now, or Pillar 2 exactly, with a grain of salt, which is that the global minimum tax will be can be collected by headquarter countries. And this will mean that the revenues from the global minimum tax will be distributed quite unequally across the globe. So we have looked, for example, in our last study at the Forbes list of the 2,000 largest publicly traded companies. And we find that a quarter of them are headquartered in the US. And another quarter are headquartered in all the other G7 countries without the US. So already 7 countries headquarter 50% of the 2,000 largest multinationals. And this will have an effect also on the revenues, or who will get the revenues of this global minimum tax. I would doubt that this can be, like, this imbalance can be compensated by the redistribution of, or the reallocation of profits through Pillar 1.
Okay, thank you. Perhaps that's a good way of transitioning to Lucas Chancel. There's a lot of money on the table here, apparently, in new revenues for governments, but the concerns about they will just go to the richer countries around the world. What do you think? Is this? Are you concerned that this isn't actually a revolution for inequality in any way?
Thanks a lot, William, and good morning, everybody. So perhaps 2 points here on inequalities between countries, but also inequality within countries, and that really is the key thing about corporate taxation. It essentially is a backstop for progressive income taxation, and this is largely why it was implemented initially in the early 20th century, when rich countries created progressive income taxes. Well, they realized that without a corporate tax, rich individuals are going to incorporate, meaning that they will become corporations and they will be taxed exactly as corporations. And if you don't have this minimum tax on corporations, you just cannot have tax justice at all. And this is one of the reasons why it has been so problematic over the past decades to move, for instance, in the European Union from an average standard corporate tax rate of about 50% to less than 25% on average. And so that really is why this is so important for tax justice and for inequality. Now, is this deal historic? I think it's both, historic and historically insufficient, meaning that I remember the days when everybody was saying this is never going to be possible. This is so utopian. Don't just even mention it. And actually, it was possible to reach this agreement. So from 0 to 15, that's a lot of progress. But look, if you go down the streets of Paris, you will see all these businesses. Some of them were very, hit by the COVID crisis, and well, the corporate income tax they pay, the standard rate for a lot of them, at least on the part of their profits, is still around 27%. So that's still way above the 15% minimum. So this, continues to create a form of inequalities between businesses, medium-sized businesses and big multinationals, which can continue to, evade a part of their profits and pay the 15% rate. But it's much, much better than 0% for sure. So new resources for governments, that they can use that to fund redistribution. And so on the other part of the question, I think there really is this issue about the global reallocation of profits. And here, I'm very much in line with what Theresa was suggesting here, that from the point of view of the global south, this is not particularly a good deal, and it's important to have this in mind in the current situation where inequalities between rich nations and poor nations are actually kind of increasing right after the COVID crisis. So there is a lot that has been done, but there's still a lot to be done in the coming months and years to increase this rate, to ensure that there's no further race to the bottom in a region like the European Union. There is still large scope for race to reducing standard corporate tax rate on economic actors of the daily lives, and so that's the first point. And the second point is moving towards a better global reallocation of profits between rich countries and low income and developing countries.
Okay, excellent. Thank you very much. I think we'll probably move on to and you mentioned the race to the bottom, which is going to be the second part of our discussion today. And perhaps we start off with the loopholes that Theresa mentioned. Sven Giegold, do you think the 15% is really a flaw? I mean, you've talked about how it only cover corporations, but even for those corporations, are you worried that this won't be as watertight as it should be?
Well, while we were waiting for the technical problems to be solved, I was trying to tease David a bit, but I didn't manage to. So now you can help me, William, to get some responses. So obviously you can, for instance, there are certain issues which could be read as circumventions, and Theresa talked about this phenomenon already. So for instance, if you get a sort of deduction to your tax bill and you get it paid out as a subsidy, how will you ensure that this is not hollowing out the minimum tax regime? My understanding is that this is what is happening in Ireland, and this would of course be against the whole spirit of the system. Secondly, there is, of course, so this is the what is talked about as refundable tax credits, for instance, for research and development, because direct subsidies are not included. There's also the question of the deductibility of costs in reducing the tax base. And it would be great to, there was Reuters reporting about this potential large loophole in the tax deal. And my fear is that, of course, in the end, in order to find a compromise, there will be lots of loopholes like this. Just a precise comment on two issues. First, I do agree that there is the role of the danger that the whole deal serves too much the headquarter countries, because it is technically not a minimum tax. Although it's always called a minimum tax, it's technically the possibility of an add-on at the location of the headquarter. However, I would disagree with Theresa that it's so bad as described, because this certainty that the multinational will pay the tax anyway at the location of the headquarter will give the source countries the possibility to tax the respective profit themselves. And therefore, the whole debate is now about helping source countries to tax. So I would put it a bit bluntly, developing countries should complain less. They should get effective source taxation off the ground, and this deal will help them to do this. And the second issue I wanted to say is, of course, there is a big issue in this revolution of the problem that the Bastille is defended by a wall of consensus. So the wall of consensus always leads to difficulties agreeing to progress. And therefore, all energy has to have two strategies at the same time. One, to help OECD and the global level to build the global deal. And second, to join forces with committed nations to step up the measures for their own jurisdictions, which can be a plurilateral approach. But and that is very important. So in this tax revolution, in order to get the Bastille conquered, we need to, in minors, to undermine the wall of consensus. And these minors were, which brought to the end the walls after the medieval period, because walls were simply not sustainable anymore. And therefore these minors, these modern minors, which means, for instance, that member states of the OECD get tough on special regimes, on circumvention of rules, of countries which are allowing places for corporations where beneficial owners are not in reality published, companies registered without public, transparent, beneficial ownership registers. All these lack of measures where you can't get a deal at OECD, member states and individual states can nevertheless name and shame and sanction such practices. And this has to happen in order to finally bring down this wall of consensus in this revolutionary struggle for the Bastille of tax competition. So this would be my words as a politician.
Okay, thank you. Well, perhaps we'll go straight to David.
Like this, starting on Monday when I'm Secretary of State in the Economy Ministry. But for a few more days, I'm free to hold speeches like this.
Well, I'm glad we got you now then. And then perhaps we'll go straight to David then to respond to this issue of loopholes that Sven says he failed to pick apart earlier on. And also, I gather there's also a question of whether there would be another public consultation on Pillar 2, and whether you think this would be a risk that we would get even more loopholes or delays.
Look, thanks very much. And in responding to that question, can I just bring together a couple of the points that have been made and make a couple of quick clarifications. Firstly, I think that across the board, there has been a recognition that the importance of this goes beyond the corporate tax. And you need to think about the financing demands on governments generally. And the corporate tax is an important part, and it cannot be seen to be an evaporating component of the tax base. And this deal will secure the corporate tax moving forward. And that, of course, takes pressure off the other taxes like the personal income tax and VAT, etc. And I think Guntram made that point very well. In terms of one thing that I must react to is the comment that Theresa made, and I support and agree with much of what Theresa said. But one thing that she said that I must point out as being incorrect is the idea that the only means by which the Pillar 2 is implemented is by headquartered locations collecting the tax. This is not true. It is not true. There are three interlocking rules, three primary rules, and that is the GLOBE rules, the income inclusion rule, which allocates the taxing right to the headquartered jurisdiction. But there is also the undertax payments rule, which essentially provides the taxing right to the source jurisdiction. Now, taking precedence over those two rules, where it is to be applied, is the subject to tax rule, which will be a rule that will support and benefit source jurisdictions and has been a big part of the negotiations for the developing countries. Now, having said all of that, the beauty of these rules is that they all interlock, and they send a very clear message that it doesn't matter where you do business, you're going to have to pay the minimum somewhere. And that is actually crucial to knocking out a whole range of profit shifting activity. And when you knock out that profit shifting activity, then it will not be seeing profits booked in zero tax jurisdictions. They will be booked in the locations where the activities are occurring. And that will benefit all jurisdictions, particularly those source jurisdictions where the activities occur. And Sven made the good point that source jurisdictions can collect whatever tax is available within their jurisdiction up to the minimum. And we do think that for many developing countries, this will take away a lot of the pressure that they currently face in having to offer, wasteful and inefficient tax incentives under the guise of attracting investment, much of which would have already taken place in that jurisdiction. They will be able to say to those investors, you're going to have to pay 15% somewhere, pay it here, and at least then it goes to the location where you're actually extracting those profits. So I think that's an important point. Now, on the so-called loopholes and things of this nature. Yes, this is a compromise agreement, and it is a consensus-based agreement. And Sven has criticised the consensus-based nature of it for reasons that he's very transparent about. But I have to say that if we want to stabilise the international tax landscape, consensus is needed. Because what we need is a set of rules that can be embedded in both tax treaties and domestic legislation that can ensure consistency. And so that, yes, we are taxing corporations that should be taxed, but we are not double taxing them. And let's not forget that double taxation, and in some cases potentially multiple layers of taxation beyond that, are likely to have negative impacts on the global economy more broadly. So let's tax, but let's do it in a way that is coordinated and consistent. And if you don't have that consensus and countries keep doing their own unilateral things, then you'll have the instability in the system that we're actually trying to resolve. So that is part of the reason why we have them. Now, the rate and the substance-based carve-out, 2 points that have been made. Firstly, the intention has never been to remove tax competition completely. But that has not been the intention. And if there's any doubt about that, have a look at the words of our Secretary General in the press release announcing the agreement. This is about a multilaterally agreed floor on or limit to that tax competition. Now, what is the limit today? You might think it's zero. It's actually not zero, because there is nothing to stop a country from providing a corporate tax regime that provides a subsidy to investment in its jurisdiction. We will be lifting that up as a result of this agreement to 15%, and that is not a statutory rate, it's an effective rate. And look, anyone that has undertaken serious analysis around effective rates know how hard it is to get that information, but secondly, know that there's a lot of activity happening below 15%, even in many jurisdictions that have statutory tax rates that are well above 15%, in some cases 30%. So this is significant. Now, there is the substance-based carve-out, and that in some instances will mean that there may be something slightly than 15% that is being paid, and that will be permitted within the terms of what I must describe as a very modest carve-out. Now, what is the carve-out? We talk about it. It means that you can take into account substantive activities that are occurring in that jurisdiction. So this is of no use if you're booking profits in a jurisdiction that's just on paper and there's no activity happening there at all. It only provides a benefit if you actually have workers on the ground and you have tangible assets in the jurisdiction. And to the extent that you do, you will be given a slight accommodation on that, to the extent that by the time it's fully phased in, that you will be able to receive 5% accommodation for payroll and tangible assets. 5% of that will be taken into account. Now, that is not going to vastly change the final taxing position, but it was an important part of the overall agreement. And to secure consensus, it was a crucial part of that agreement. We believe that it maintains the integrity of the deal, but it is something that recognises, as we did through the BEPS project, that there is something different between profit shifting shifting profits into jurisdictions where there are no substantive activities and actually having those activities on the ground. Sorry, final point to make, and that's about non-tax competition, because I think Sven alluded to this. Now, it is true that there will continue to be competition amongst nation states to attract investment using non-tax tools. And this minimum tax does not seek to constrain that. And that's because that would be going well beyond tax and would be starting to get into a whole range of other policy areas that, frankly, the people involved in the negotiations did not have the competence to speak on behalf of their governments for. But I make this point. The reason why tax is so important is that governments offer tax incentives because it's the magic of investment incentives, because it's the most magical form, because you say, I don't have to put any money on the table today, but I forego revenue into the future. Whereas if you provide other subsidies, direct payments to companies, you have to actually come up with the cash, and that has to be budgeted, it has to be on the books, and that is much more difficult and also more transparent often than providing tax incentives. So on the question of tax competition more broadly and investment competition, yes, there will continue to be other forms of non-tax instruments used, but they will be much more transparent, and I think they will be much more difficult for governments to engage in, because it's not about revenue foregone. It will actually involve stumping up money at the front.
On this point, both made by Sven and David, perhaps come to Guntram about this. The ending this race to the bottom, or at least slowing this race, or putting a limit on it. Do you think it opens up the possibility for governments to suddenly start ending this competition and so start competing in more virtuous policy areas, whether that be investing in education or transport or whatever it might be?
I mean, that's a very broad question. I mean, I would say countries already do that, of course. I mean, of course, the quality of staff and of workers, the education system. I mean, all of these are very important. The infrastructure that is provided, the digital infrastructure, do you have broadband access, et cetera, et cetera. I mean, all of these things are important considerations for any company when it decides on where to locate and where to put its activities. Now, I do think, given that there are also significant differences in the level of development and therefore also in the level of the underlying infrastructure, some differentiation in taxation rates is justified. I mean, so if you are a poor country with very little infrastructure, you might, I mean, you don't want to tax your local companies as if you were a country that is offering much more to companies that locate in that country. So in that sense, I do think what this deal does is it sets a floor, and I think that's important to have that floor. But some differentiation is needed also because the level of infrastructure is very different. And in particular, when it comes to local entrepreneurs, I mean, local entrepreneurs that basically have to work, I mean, do not have the choice where to locate their activities. I mean, they are in a country and want to do something in that country, and they have to work with what they have. And so in that sense, I do think some of the carve-outs I think are probably justified, and long transition periods are also justified. But I think overall, again, I think the key issue is that we have a floor, and that especially for the bigger companies, there is now a floor, making sure that some taxes are paid. That's, I guess, the way I would see this carve-out issue.
Okay, perhaps I come to Theresa on the who's on the point of these revenues. What do you think the governments will do with them? And do you expect, from looking at how governments behave on tax policy, do you expect, as David said and suggested, that governments will raise their tax rates to 15% because they may as well claim that tax rather than the headquarter country?
Yes, thank you for this question. I would like to make 2 points on it. I would like to start by reacting to what David and Sven said. I see your point, but I think the income inclusion rule is like the one that will create most of the revenues. And when we look at developing countries like African countries, they already have quite, most of them have corporate income tax rates above 15%. So they're not like pressured down, but what happens is that profits are flowing out to tax havens and then with the income inclusion will be taxed by the headquarter country. So we cannot look into the future, but there are different scenarios, and I think this is also very likely that might persist. But I agree with David that the minimum tax gives will curb paper profit shifting to shell companies that don't have any real economic activity. And there will be this lower floor of 15% because there won't be carve-outs that can be applied there. But when we look more towards Europe, where a lot of companies have subsidiaries with real economic activity, 15% is not the floor. And this is what I'm concerned that we cannot curb aggressive tax competition there, because as I said before, let's start with talking about Europe a bit. Europe is still a bit divided in Western European countries with a lot of headquarters and Eastern European countries with subsidiaries. And the deal as it is now, since it doesn't give a lower floor of 15%, still encourages countries like, the best example is Hungary, to engage in tax competition, even though it is now for real economic activity. And so I don't think they will change their strategy from attracting FDI by offering low taxes and by offering low wages to a more virtuous model of having high skill and good infrastructure. Because when we look at Hungary, Hungary will keep its 9% corporate income tax rate, and then there will be a top-up tax of 6%. But if multinationals concentrate real economic activity like assets and employees in this country, they can substantially decrease their tax burden by this. And so there's still quite a margin, and I think this margin is especially important for Europe, because in Europe it's much easier to move assets and employees across borders than in other contexts, because we have the European Union, and this movement is an advantage in many cases, but here it might actually be a disadvantage because it's so easy to concentrate or to increase your carve-out and to decrease your tax burden of the global minimum tax. So I think we should really monitor what it does to tax competition, especially in the EU.
Okay, thank you very much. And perhaps just to conclude this section, Lucas, Chancel, is 15% just simply too low? Do you think it's feasible and desirable to increase that rate over time, or are there other priorities for international tax reform?
As well, I think in part I've said a few words about that before. Comparing the tax rate on non-multinational actors in a country like France with what multinationals can pay on part of their profits. But perhaps we have this deal, and it will be very important to be able to evaluate it in a transparent manner. And, I'd like to stress the fact that it's important that tax administration do that, and they will have a lot of information. But what we would like as, researchers, civil society, is the ability to also do this evaluation and to do it well. And so far, we'll be able to do it a bit better than a few years back, in particular with agreements like the country-by-country reporting, which is asking firms to tell and to publicly disclose how much taxes are paid in this or that country. But in the context of the European Union, the only information we will have are going to be taxes paid in European Union countries and countries on a gray list, which actually it's better than nothing again, but it leaves aside most countries in the world. Most countries in the world will be reported as a block. So we will not have detailed country by country reporting on most countries in the world. So this will this makes it very difficult, very hard to, to understand where we are, what exactly the progress has been done, and how to move forward. So I would really like to stress that this deal needs to come with with transparent tools to assess it. And so far, I think we're not completely there yet. And to pick up on what Sven was saying at the beginning, was saying that some, mid-size actors were left out of the deal. Well, that's also the case for this transparency agreement in Europe, the CBCR, country-by-country agreement. A lot of mid-size actors are also left out of this requirement to disclose publicly what taxes are paid where and in which country. And that's really, a key other element of the discussion. That's the public evaluation in a transparent manner of what we're doing. Otherwise, the risk is that we'll claim that we're doing a lot of progress, and in fact, we realize that progress is not at the rendezvous. So we need to evaluate this in a sound way and in a systematic manner.
Okay, thank you. The next section we were going to do was implementation and what comes next. But I'm very aware that we have running close to the end of our time after the delayed start. So perhaps, I don't know if it is actually technically possible. Can we open it up to questions from the audience? Is that possible from the room in Pearsa? I take that. Oh.
We do have a first question in the comments, one by Sarah Goddard, who asked us, I understood that developed countries have a hard time taking profits because they are shifted to tax haven. How should they tax those profits at source, given that double tax agreements usually reduce their right to apply withholding tax? Many developed countries have higher tax rates than 15%, so profits will persist. As a result, the headquarter countries will collect most of the additional tax revenue.
Perhaps it's a question for David to respond to, how we can deal with that.
Look, thanks. Good question, and I'll try and explain. So the first thing is I'll start with the statutory tax rate issue. So it is true that many developing countries have higher statutory tax rates than 15%. But as I think there's even been consensus on this panel, when we look at the effective tax rates, often they are well below the statutory tax rates. Let me just give you an example. I won't mention companies or countries, but you're an African nation that has a cobalt reserve. Multinational comes in and says, we want to unlock that resource. They have a discussion. There's an agreement reached about a tax holiday that will be provided for the first 15 years of the firm's operations. These types of agreements are not uncommon. Certainly for that 15 years, there will be no tax paid. So you could have a 35% statutory tax rate, but in this particular case, the biggest, the multinational with the biggest presence in this country actually happens to be one that is subject to no tax at all and doesn't even in some cases have to report. So in this instance, the local government will have the opportunity to engage in a discussion with the company and to say, well, let's say that company is headquartered in a European country. Then we say, well, you're going to have to pay 15% in that European country. Why don't we renegotiate the arrangement that we have here in our local jurisdiction and you pay that money here? And frankly, I think from the company's perspective, they've got to pay it somewhere. There are many benefits in being able to say that you paid it in the jurisdiction where you're actually undertaking the mining or resource activities. So we would think that in those instances, it would take some of the pressure off. It may be that the company said to the country, if we don't have a tax holiday, we'll go to your neighbouring country and we'll unleash the resource there. Those types of negotiations will be a very different proposition when both parties know that that company is going to be subject to a minimum 15% somewhere. So that's the first point about the rate. Second point about profit shifting. the under-tax payments rule, it is essentially a means by which there can be a withholding of payments out of the jurisdiction. So that is a new tool that could be utilised by source countries. And separate to that is the subject to tax rule. And the agreement basically says that for specified developing countries, where they have a tax treaty with another country, then that other country will be required to introduce provisions for a subject to tax rule that will allow the withholding of payments up to a nominal rate of 9% by the local jurisdiction. So these are two examples of where developing countries can act. But let me just say the two final points that are really crucial. One is that developing countries are able to introduce effectively minimum taxation in relation to activity within their jurisdiction under their sovereign right as a nation. Now, that is one way that they can ensure that the activity that is occurring in their jurisdiction is not leaking offshore, either through profit shifting or collected by way of top-up tax by a headquarter jurisdiction. Separate to all of that, what Pillar 2 does is it wipes out that profit shifting, especially to the zero tax jurisdiction. And that means that we will see more profits being booked in the locations where the economic activities are occurring. And that is overwhelmingly a positive thing for developing countries. And through the BEPS project, that was one of the principal objectives that we were seeking to pursue. So I hope I've responded to that question sufficiently, but simply to say that, yes, we do expect a significant amount of additional revenue for headquarters countries as a result of the income inclusion rule, but it's not the only rule. There are many other tools at the disposal of developing countries. And the final point to make is don't forget that Pillar 1 actually is allocating to market jurisdictions the right to tax corporate profits for the first time, really, in the history of the corporate tax. And that is something that means that there will be no loss of tax revenue for developing countries. It will only be gained because they are markets that no developing countries have a multinational that will be subject to Pillar 1, at least at this stage, that would be headquartered within their jurisdiction. So that is a net gain in revenue in addition to what Pillar 2 does.
Okay, thank you. I don't know if there are any more questions. I'm aware that we're almost out of time. Are there any more questions from the room at PSU?
We do have time for a quick question. So would any of you like to add something? If you need, we can also gather your question and send you a written answer later as a kind of compensation. So yeah, so I think we are going to leave the floor to Mr. Nicolaides for a quick conclusion, and thanks you all for once again your huge patience.
Okay, I don't know if Will would like to make like a quick remark, or just I can also close the panel discussion because there are also more events to attend in the conference. So Will, any quick remarks?
I mean, very briefly, I'm not sure we have got a primarily revolutionary pocket, as Sven said. And it's clear that there's a lot more work to be done and a lot more, and as Luca pointed out, it'd be good to have real transparency on the impact of this. Otherwise, we will be unable to ever say whether it was revolution or not. That would be my concluding remark, but I'll leave it to you to announce what's coming next.
Yeah, thanks a lot. So let me thank everyone for attending, all the panelists, and Will, the moderator, and also everyone who attended both online and in person. I think it was a very interesting discussion, and apologies again for the technical problems in the beginning. Just to give a quick heads up of what's coming up on our side, we're preparing a new report at the end of January, accompanied by an event which would be on the who owns real estate in tax havens. And this should be out at the end of January, around the 24th of January. So you can follow our events and activities in the social media or subscribe to our newsletter on our website, where you can find also our reports and our tools. With this, let me thank everyone again and wish you a very good rest of the day.